There's always going to be business. Business is always going to be important to the body politic as well as be interesting to a lot of readers.
In this video, I'm going to share Warren Buffett's top 7 investing rules that have made him one of the richest people in the world. When it comes to investing, few people have as much experience or success as Warren Buffett. Over the course of his career, Buffett has become one of the world's wealthiest men, and he's often considered to be the greatest investor of all time. So what's his secret? In large part, it comes down to following a set of simple rules. And in this video, I'm going to share those rules with you so you can start investing like a pro. Most of the time, investors and traders start great ideas, but they aren't so great in practice. Investors may bet on 20 good ideas in their lifetime, if they even have that many, and assume they will make money, but this could be a mistake. Buffett says 3 or 5 or 7 might make you wealthy, but what you can't do is get rich by trying one new idea every day. The Buffett rule is to focus on a few great ideas instead of lots of good ones. This is a principle that can be applied in all areas of life, not just finance and investing. This rule forces focus, which is something Buffett is familiar with. He once said, "The difference between successful people and really successful people is that a really successful person says no to almost everything." So Warren Buffett's 7 rules to investing. Here's number 1. Managers must have integrity and talent. Warren Buffett, speaking to a class, said, "You're looking for 3 things generally in a person: intelligence, energy, and integrity. And if they don't have the last one, don't even bother with the first 2. I tell them everyone here has the intelligence and energy. You wouldn't be here otherwise. But the integrity is up to you. You weren't born with it. You can't learn it in school." These comments reflect Buffett's general philosophy on investing, which emphasizes the importance of making sound decisions based on comprehensive research. In other words, managers must be honest with themselves and with their shareholders in order to make the best decisions for the company. This philosophy has served Buffett well over his decades-long career, and it's one that any manager would do well to heed. While many investors focus on financial metrics like earnings and revenue growth, Buffett knows that it's the people running the company that will ultimately determine its success or failure. Rule number 2, invest by facts, not emotions. Make quantified investment decisions based on the math and the facts of a business compared to the stock price. Don't let your emotions of fear or greed influence your decision. According to Warren Buffett, price is what you pay, value is what you get. Buffett believes that emotions like fear and greed can lead to bad investment decisions. Instead, he relies on a disciplined, analytical approach to investing. This involves researching companies thoroughly and making investment decisions based on hard data. Rule number 3, buy wonderful businesses, not cigarette butts. It's one of Buffett's key pieces of advice, to buy wonderful businesses, not cigarette butts. In other words, it's better to invest in companies that are doing well and have a bright future, rather than those that are struggling and may not be around for much longer. This may seem like common sense, but it's an important principle to keep in mind when making any investment. After all, you want to put your money into something that has a good chance of appreciating in value, not something that's likely to lose you money. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. Rule 4, only buy stocks that you understand. Don't invest in stocks just because other people are investing in them. You need to do your own research and understand what you're buying before you put your money into something. Know your circle of competence and stick within it. The size of that circle is not very important. Knowing its boundaries, however, is vital. Warren Buffett. This approach has served him well over the years and has helped him to avoid making costly mistakes. Now, while it might be tempting to try and invest in everything, it's important to remember that it's better to focus on a few things that you understand well. Number 5. If you see a great opportunity, take it. Warren Buffett says, when it's raining gold, reach for a bucket, not a thimble. Buffett has always been quick to seize on good opportunities when they arise. He once said, if you don't find a way to make money while you sleep, you'll work until you die. That philosophy has served him well over the years. In 1964, he bought shares in a struggling textile company called Berkshire Hathaway. The company wasn't doing well at the time, but Buffett saw its potential and invested anyway. Today, Berkshire Hathaway is one of the most successful companies in the world, and Buffett is one of its largest shareholders. His willingness to take risks and seize opportunities has made him one of the richest men in the world. Rule 6. Don't sell unless the business fundamentally changes for long-term investors. Our favourite holding period is forever. Warren Buffett. One of the most important pieces of advice for long-term investors is to resist the urge to sell. It's something that Warren Buffett emphasises time and time again. In his view, selling should only be considered if the business in question has undergone a fundamental change that makes it no longer a sound investment. For example, if a company's competitive position weakens or its management team changes, then selling may be the best option. However, as long as the business remains fundamentally sound, investors should hold on to their shares. After all, even the best businesses will experience ups and downs, and it's only by holding on through the tough times that investors can reap the rewards in the end. Rule 7. Buying at a price below intrinsic value requires some fundamental analytical skills. Intrinsic value is the calculation of an asset's true worth, regardless of its market value. For example, a company might be trading on the stock market for $5 per share, but its intrinsic value might be $8 per share. So if Warren Buffett were to buy shares in that company at $5 each, he would be buying them at a price below their intrinsic value. To calculate intrinsic value, investors like Buffett use a number of fundamental analytical skills. They take into account factors such as earnings power, growth potential, and the level of debt on a company's balance sheet. By carefully analysing these and other factors, they can get a better sense of a company's true worth and make investment decisions accordingly. While there is no guarantee that buying at a price below intrinsic value will always lead to success, it's clear that it requires a certain level of skill and expertise. Those who lack these skills are likely to find themselves making poor investment decisions. If you understood a business perfectly and the future of the business, you would need very little in the way of a margin of safety. So the more vulnerable the business is, assuming you still want to invest in it, the larger margin of safety you'll need. Warren Buffett. And that's all. Of course, there are no guarantees in investing, but by following these rules, investors give themselves a better chance of achieving their financial goals. Whether you're just starting out or have been investing for years, it never hurts to be reminded of the basics. And there's no one better to learn from than Warren Buffett himself. Thank you for being all ears throughout the entire video. To create his effort, to copy his genius, Albert Einstein. And if you want to expand your income by building an online income, feel free to contact me, so we'll get things moving right away. Remember, if you want to change your life, let's make a change together. You need to make a change.